The two main solutions that we're going to look at today are using asset allocation. And when I talk about asset allocation, I'm not talking, we don't do it the old static way. We've evolved. We're using pretty advanced dynamic modern portfolio theory, which I'm not going to dive in today, but we're definitely not static or traditional calendar rebalancing and mean variance optimization. There are some more sophisticated statistical procedures and processes nowadays that will help you build better portfolios. And then we'll talk about how we reverse engineer a return and use some software that we developed to maintain our fiduciary recommendations. Again, here we're just going to prove it to the client by using an optimization process to build a total portfolio. And we're going to use the required rate of return calculator to show the math. And again, I think it was worth repeating that annuities offer reasonable returns with reasonable risk. So let's educate the client, stop selling, and treat them like an asset class that they deserve to be treated as. Okay, some of you may have seen this. This is BlackRock's capital market expectations. So BlackRock's, iShares, one of the largest providers of ETFs out in the market. Their analysts believe that over the next 5 years that the U.S. equity market is going to produce about a 4.1% return, and that the Barclays aggregate is going to produce just shy of 2%. So that your old static 60-40 portfolio is going to give you about a 3.2% expected return. Now you can disagree or agree with these numbers. These are just what BlackRock's saying. But my point is that if you can use an annuity as an asset class, that's going to give you 100% of participation in the S&P 500 up to some cap. Let's just say that cap's 5%. In this case, you'd be able to get 100% of the upside return of the equity market in an annuity with zero risk, right? Because they're bound by zero in the contractual guarantees. So we could buy the S&P 500, we could buy the SPDR, and we could get 4.1%, taking about 15% of risk, the volatility, or we could use an annuity that's going to have that same type of upside, but with none of the downside. So right now, I think it's a really good time for annuities as asset classes because the properties that they have are working out very well statistically in the optimization process. And I'll demonstrate that to you in a few minutes. But again, if we're only going to get 4% of the U.S. equity markets going forward, and we can get 100% of that in a fixed index annuity without the risk, it sounds like it belongs in the portfolio somewhere. So looking back, excuse me, looking back to 1995, in order to get 7.5% return, you could do that with a 100% bond portfolio. And you only had to take 6 degrees of risk measured by standard deviation. In 2005, to get that same 7.5% expected return, the risk increased about 50%. It went from 6 to almost 9%. In 2015, you can see that same 7.5% expected return now carries something close to 17% risk. And we've had to use a lot more asset classes than just bonds. We've had to use large cap, small cap, international real estate and private equity. So the risk paradigm has changed. The Sharpe ratios have come down. The risk-reward ratios have come down. And we're in an environment that there's a lot more risk, but not as much upside. And so again, going back to the prior slide, you can see that if the equity market's only going to do 4, and an annuity being able to do 4 with no risk, sounds like something that we might want to be talking to clients about.